This video is based on A-level business studies and it's looking at the financial unit with regards to debt factoring. So debt factoring, you'll be studying it when you're looking at sources of finance, but it's key when looking at cash flow as well. So to begin with, just look at this diagram. You've got the customer, you've got the debtor, you've got the factor. So what I just want to bring special attention to is what is meant by the debtor and what is meant by the factor. So just to begin with, debtors are individuals or businesses that owe money. Okay, so debtors can owe money to banks, individuals or companies. And in this context, we'll be looking at those debtors owing money to companies. So debtors owe a debt that must be paid at some time in the future. Now, for the company that is trying to collect that debt, that would be considered to be a trade receivable. For the company who is the debtor and who owes the money, then when they pay it or pay that debt, that is considered to be a trade payable. So a factor is an intermediary agent that provides cash or financing to companies by purchasing their account receivables. So in other words, they buy the debt. So if, for example, you've got a company that is trying to chase those trade receivables, what they may do if they're struggling to actually get that debt from that company, they may just simply sell it to a factor. So a factor is essentially a funding source that agrees to pay the company the value of the invoice less a discount. So they're not going to collect it for free. They're not going to simply, for example, if a company owes £100,000, the debt factor is not going to just chase that £100,000 to give back to that company. They will obviously charge for that. So what it'll be is they'll buy the debt but at a discounted rate, or they'll include commission or fees. So let's imagine we've got and this is from an old AQA paper, and it was about a boxing company. So Boxers Ltd. Their success depends in part on meeting tight delivery deadlines in an increasingly competitive market. It's very flexible and responsive to requests from its major customers to produce different sizes and types of boxes, often at short notice. It's delivering a reputation for consistently good quality products, and in 2010 it borrowed £1.1 million to invest in new production line technology, although this led to high interest charges. Now, in terms of the case study, it provided this information as well. So the average trade credit offered to their major customers is 60 days. So that would be in terms of their trade receivables. However, they receive trade credits from their suppliers, but only of 27 days. So that means that their trade payables are every 27 days, but their trade receivables will be 60 days. Straight away, you can see a problem there. And the problem is that they have to wait 33 additional days before they receive payment from their customers after they've made the payment to the suppliers. So it's almost like they're paying the suppliers, they're paying their suppliers twice over before they even receive any income from their customers. Now, when we're having a look at that obviously, it really does bring about potential cash flow problems. So when we're looking at the reasons why you might want to turn to a debt factor at that point, is because if it's putting pressure on your cash flow, and let's face it, this industry or this market that they're operating in is very, very competitive. So they may have to offer these trade credits to their customers in order to try and get that demand or generate that demand. Because if they didn't offer those trade credits, they may lose that competitiveness, because maybe that is what's helping them to stand out to their rivals. But at the same time, they've had to borrow £1.1 million to invest, which is going to put a lot of pressure with regards to their outflows because of those loan repayments with high interest charges. And they're also having the pressure of not receiving any income from their customers until after 60 days, even though they have to pay their suppliers every 27 days. So one of the reasons why we turn to a debt factor, or why a company might turn to a debt factor, is for these three key reasons. So number one, to improve cash flow. And that's absolutely crucial when we look at the example that we've looked at from a previous AQA paper. So the ability to improve cash flow is it allows businesses to instantly release the cash value of their invoices. So what that means is they're not having to wait for payment, because as soon as they sell that debt onto a debt factor, they'll instantly receive that cash. Okay, it might not be the whole sum, but they'll receive the majority of it. And that majority might be desperately needed if they're experiencing cash flow problems. It'll also lower the risk of potential bad debt, because obviously they're waiting for that payment. And if they've had an agreement, so let's imagine it was 60 days, but it'd gone beyond that point, and it was, I don't know, closing on 90 days or 120 days, and you're thinking, well, why are they not paying this? Is it because the company that has requested that trade credit are in financial difficulty? And if that's the case, and it gets to a problem, or it gets to a situation where that company is actually unable to pay it, then that'll be bad debt, and that'll be debt that's written off because the company cannot afford to pay it. Maybe they've gone insolvent. But if you sell it to a debt factor, then it gets rid of that risk straight away because you've sold it, you sold the invoice. It also saves on administrative costs, because if you think about it from a company that has obviously issued that trade credit, their business is not trade credits. Their business is selling that good or service to the customer. They might not have the expertise to then chase it up. They might not have the legal knowledge or even the time and the resources to do so. So actually what it'll do is it'll save on administrative costs, and it'll free up time and resources, which then can be spent on what they actually do in terms of operating as a company rather than chasing trade receivables. And you have to remember, these debt factoring companies, that is what they do. That is what their company possibly is all about. So therefore, they will have the expertise to do so. But there are issues, and we've already mentioned one of the issues. It will be sold at a discounted rate, or there will be fees or commission attached. So when we're looking at the issues of it, first of all, it will reduce the overall profit for the business, because they're not receiving the whole revenue that they should be receiving because they've had to turn to a debt factor. So the factor always charges a percentage of the overall invoice value. Now, in many textbooks, it might say between 1% and 3%, but obviously it just depends on the situation. So depending on the size of the contract, this could be really, really significant in terms of the amount. It also may indicate that the company has cash flow problems. So whether that relates to the amount of trade credits being issued or the lack of inflows to pay their financial obligations, the fact that they're having to turn to a debt factor is probably a worrying sign for the company, and it might be something that they need to address, because yes, they may have sold it to a debt factor on this occasion, but will the problem continue to repeat? It's not necessarily a long-term solution, is it? It might fix it in the short term, but then it could be months down the line, they're in a similar situation and they're having to turn to a debt factor again.